Is Disney going to eat Netflix's lunch? Am I buying Disney stock, and what is the state of the business performance according to their latest Q3 report? Stay tuned to find out the most valuable information regarding the company and its future potential. As always said with educational purposes and is not meant to be taken as financial advice. During Q3 of 2022, the revenue of Disney grew by 26%. The whole business could be put in two main categories. Number one is Disney's media and entertainment distribution segment. Here the revenue for the quarter was 14 billion, an increase of 11%. The second category is the Disney Parks, Experiences and Products segment, while here the revenue was 7.4 billion and the year-over-year increase is 70%. This is due to the fact that most Disney parks and experiences are opened as the effects of the pandemic start to become lesser and lesser. Both of these two main business categories consist of subcategories, so let's make an even bigger revenue and business breakdown. The Disney Media and Entertainment Distribution segment includes three different parts. Linear networks, this includes all of Disney's TV channels. Then comes the direct-to-consumer segment, which includes all subscription content models of Disney. And on third place is the content sales, licensing and others. This is the third segment. The biggest growth is seen in the licensing category with a growth rate of 26%. Second is the direct-to-consumer revenue stream with an increase of 19%. And the most developed segment, the linear networks, grew by only 3%. For me personally, the biggest potential here is coming from the direct-to-consumer segment. The total paying subscribers here are totaling 221 million. As of this quarter, Disney owns ESPN+, Hulu and Disney+. The fastest and biggest growth engine is Disney+. The current subscribers stand at 152 million and they grew by an astonishing 31%. Since last year's quarter, when the total subscribers were 116 million. ESPN Plus also grew by a huge percentage, 53% to be precise, going from 14.9 million to 22.8 million, while Hulu saw a subscriber increase of 8%, totaling now 46.2 million subs. The main direct competitor to Disney's direct-to-consumer segment is Netflix, of course, which as of Q3 has 223 million paying subscribers, so now the numbers are pretty much even. But the growth of Disney is huge. While Netflix in Q1 and Q2 lost subscribers and for the whole year of 2022 has increased subs by only 1 million. Disney started to focus its efforts in this segment in Q3 of 2019, which is 3 years ago. Then Netflix had 158 million subs, while Disney had 63 million. Since that time, Netflix, which I will also cover here on the channel, has grown with 41.5%, while Disney has grown by 251%. This segment is currently losing money for Disney. The losses amount to about 5.5 billion per year. The Netflix subscription model cost is $9.99, while in December of 2022, Disney will increase the prices of their services from $8 to $11. The $3 increase per subscription only in Disney Plus will lead to an additional 5.5 billion in annual revenue. This alone will make this division of the business profitable unless Disney decides to increase the amount spent on content production. Not to mention that Disney Plus is growing its user base, and also in this calculation I do not emphasize on the other 70 million paying subscribers of Hulu and ESPN, which are also seeing an increase in pricing. Regarding the content library of Disney, for me personally, it is the best in the world and they have the most proven content in terms of likability. With Marvel, Star Wars and their Disney characters, Disney has an incredible competitive advantage in terms of moat. The IP alone for these content branches is in the range of 100 billion, as Marvel alone is valued at more than 50 billion according to Forbes. On the following chart, you can see how the market share in the direct-to-consumer space is shaping out. As you can see, over this year, the market share of Netflix is slowly falling, while Disney's market share out of all platforms is increasing the fastest. My biggest emphasis is on the streaming business, as most recently it became the top TV-like format, surpassing cable, and as you can see on the following graph, it is the only segment with significant market share increase, indicating that this is the future of content consumption. Let's now make a fundamental analysis of the business to check out how the business's profitability, liquidity, and efficiency is. For this current year, the company is not churning a lot of earnings due to increased spending in the DTC segment and still the not fully recovered theme park and experience segment. For this quarter, the net income is 1.5 billion, while for the 9 months of 2022, the net income is 3.25 billion. For the full year of 2023, analysts expect forward earnings of 7.5 billion, which will give Disney a forward PE ratio of 23, as the current market cap of the company is $173 billion. When a company has such a moat, I think the multiple is not that high, but I would like it to be below 20, so that my potential future return is higher, and with that the risk also goes lower with a lower valuation multiple. In the future couple of years, I think it is possible only the DTC segment of Disney to churn in around 6-7 billion in earnings, as the current Netflix earnings are about 5 billion, and I see much more potential in Disney's power to make higher earnings, as Netflix will need much more investments in order to achieve the same likability and recognition for their own content IP. The current ROIC and ROE efficiency metrics of Disney are not great, but this is due to the lowered earnings and the higher costs. A good sign for me when it comes to capital management is the fact that Disney bought Marvel for 9 billion in 2009, and the current value is more than 10x. Also in 2012, Disney bought the Star Wars franchise for 4.05 billion, and the returns are again more than 10x. The debt management of the company could be a bit better in my opinion. The current ratio stands at precisely 1, above 1 is needed in order for the short-term debt health to be considered good. The long-term debt-to-equity ratio is 0.51, which is okay, below 0.5 is optimal. The debt-to-EBITDA ratio is not great as it stands at 5.7, below a 3 is considered a good level, and this indicates the company has way too much debt in relation to its pre-tax earnings and income, but it is not something that is incomprehensible from an investment standpoint. In general, I think this is a tremendous business with a huge moat and an increasing growth rate. The current efficiency is not great, but most likely it will improve, and the only negative remark comes from the debt management analysis I did. If the stock price drops by 30% going from about 95 to about 65 to 70, then I would be a buyer of the company for sure. Like if you learned something new and subscribe for more stock analysis. Thank you for watching until the end, and I'll see you next time.